The next major economic crisis is not happening to the banks. It's not happening to the stock market. It's not happening to corporations or taxpayers. It's happening to the government. It is a sovereign debt crisis. And we know this is the case simply by studying history, because every single time for the last 30 years that there's been a major crisis, the next crisis happens to whoever absorbed the one from before. And knowing the epicenter of the next crisis allows us to prepare for it and profit from it. So let's go back 30 years approximately to the year 1998. There were a few guys running a hedge fund called Long-Term Capital Management. These guys' names were Merton, Scholes, and Black. If those names sound familiar to you, it's because you're an options trader and the options pricing model was named after them. It's not because these guys were idiots. In fact, they are Nobel Prize winners in economics, and they were running this hedge fund that was the envy of the entire banking world. They were making money hand over fist with a new exotic strategy that could make tons of money with zero risk. And you know what happens when somebody is making a ton of money with a strategy that has zero risk. It means there's actually a lot of risk, it's just hidden somehow. This fund was performing a strategy called relative value trades. It's a type of arbitrage trade. For a really simple example of an arbitrage trade, you could look at the two share classes of Google stock, GOOG and GOOGL. You can see that over the long term, these two share classes perform identically to each other. This makes sense because they are both equal shares of the exact same company. But when we zoom in, we can see that there are short periods of time where there is a small amount of outperformance or underperformance by one share class versus the other. And that also makes sense because different entities hold different amounts of these shares. And so when different entities have to dump or purchase large amounts of these shares, the price movement can change, which means that the short-term performance of the two share classes can be different. When this happens, it creates an arbitrage opportunity, which means you can buy the one that has underperformed and short the one that has outperformed. By doing this, you are bringing in the exact amount of money needed in order to purchase the shares, so your net outlay on this trade is zero. You also are price agnostic or performance agnostic for the company as a whole, because both share classes could go down or both could go up, and you don't care because your gains and your losses from the short and the long are going to offset each other. The only thing you're banking on is that the performance will eventually converge. Once it converges, you close the trade out and you walk away with the tiny profit in between the two. Now, obviously, you're going to be picking up a few cents here and a few cents there doing this strategy, which is not a good recipe to make money. So you're going to have to use tons of leverage with this strategy. That way, your return on your capital will actually be worth it. Mechanically, that is exactly what long-term capital management was doing. They were just doing it with currencies and bonds and more exotic instruments. But mechanically, they were just finding things that had diverged that statistically would converge again. They just had to hold long enough until it converged to make the trade worth it. And that's where the problem came in. Because on paper, this strategy had zero risk. But in 1998, it started to blow up because there was so much money riding on these trades that when it didn't start to converge when it should have, and it diverged a little bit too much, that forced some traders out. That forced some money to close out their positions before it had converged, which made the situation worse. They're buying what they shorted and they're selling what they were long, which drives the divergence even further apart. That squeezed the rest of the market, and you started to have traders all across the world get closed out and margin called, and very quickly this was tipping over to the point where the entire global financial system was at risk of collapsing. So the Federal Reserve got together with a couple big banks, and they said, hey, we need you to deal with this problem. The Federal Reserve did no printing, they did no cuts, they just told the banks, you better handle this. And the banks handled it. They got together and they purchased and bailed out long-term capital management and wound it down. If you're interested in a really good book about this story, I can I highly recommend When Genius Failed by Roger Lowenstein. Very good book on this topic. But that situation came and went, and most people never even knew anything about it. But it set the stage. It set the precedent. It planted the seed for future bailouts. And like I said before, the next crisis always happens to the entity that absorbed the last one. So in 1998, the banks bailed out a hedge fund. They swallowed that storm. And in 2008, just 10 years later, they were the epicenter of the new crisis. Now, we don't need to go into as much detail about the great financial crisis because you lived through it. It was big news. Everybody's seen the movie. We all know what happened. But just as a recap, for years, the Federal Reserve had been lowering rates. One of the reasons that they were doing that was to soften the blow from the dot-com bubble bursting. That wasn't an economic crisis. It was just the stock market falling. And that blew up a new bubble in the housing market. Everybody was taking advantage of adjustable rate mortgages, buying multiple houses. There was euphoria, and the banks were packaging up all of these loans into collateralized debt obligations, mortgage-backed securities, and selling them off to investors. Now, most people aren't aware that the reason this blew up and became a threat to banks is because of something called the repo market. The way that banks work is that if they run out of cash at the end of the day, they will just borrow cash from another bank. And in order to borrow that cash, they will pledge an asset that they promise to repurchase in the future. That's the word repo, comes from repurchase. If this sounds like a pawn shop, it is. It's just the biggest, most complex financial pawn shop. So a bank will give collateral to another bank in exchange for cash and say, hey, tomorrow or next day or next week or sometime in the future, I'll buy that collateral back from you. Now, in the financial system at that time, most of the collateral was these mortgage-backed securities. But once everybody realized that the mortgages weren't getting paid and these things were all going to collapse, that collateral went from being good collateral to bad collateral basically overnight. And suddenly no bank was willing to accept mortgage-backed securities as collateral, which meant one morning you wake up and you're a bank and you realize I don't have the cash I need and nobody will take my collateral. I'm done for. You instantly go under. That's why the banks started failing. And so very quickly, the government orchestrated a bailout of the banks. And they did so at the expense of the taxpayer. And when I say the taxpayer, I'm not saying that you saw your taxes go up on your paycheck of an equal amount to pay the banks what they were about to lose. When I say the taxpayer, I mean the average individual in society who is forced to pay taxes, and the government decided we're going to take a bunch of money and take on a bunch of debt and take on a bunch of future obligations in order to make sure these banks don't fail. And the cost of that over the next decade was rising prices of food and services, rising cost of housing, yes, increased taxes, a worse jobs market, all of the consequences of propping up failure, of subsidizing loss, was slowly realized in sneaky, insidious ways by the taxpayer, the average American individual. So in 2008, the taxpayers bailed out the banks. Then 2020 comes along. Just like the financial crisis, most people are not aware that this crisis also was not what everybody was talking about in the news. And by the way, if you're wondering why I won't say the word, I haven't said the word on YouTube since January of 2020. But we all know what started to happen in 2020 and what everybody was concerned about. And that's not the reason there was an economic crisis. The crisis actually started in September of 2019, a few months before, guess where? The repo market, just like it did in 2008. Go back and look at repo rates in September of 2019. You can see the interest rate in the repo market spiked. The same exact thing that happened that sparked the great financial crisis. Now, this time, it wasn't because the collateral in the system was bad. This time, it was just because the government had borrowed so much that it had sucked all of the liquidity out of the financial markets. And again, it had borrowed so much because it forced the bailout of the banks onto the taxpayer, and it was now having to fund all of those expenses through debt and borrowing. That sucked all of the financial liquidity out of the system, caused the repo rate to spike, and banks were once again at risk of failing. There was some light intervention to prevent banks from failing from just that repo spike for a couple of months when the Fed did not QE. But in 2020, when the crisis started, it gave policymakers a perfect excuse to do a full-blown bailout again. And this time, it was directed at the taxpayer. And don't get me wrong, I'm not saying that you, as an individual who is forced to pay taxes, got a big bailout and were financially better as a result. I'm saying that the government decided we are going to print and borrow into existence trillions of dollars, and we're going to hand out a substantial amount of that to people who consume. We're going to do this to cover up the rest of the money that we're injecting into the economy, into corporations and into banks, but we're also giving a lot of it to taxpayers, to people who will just spend that money on stuff. The reason they did this was, again, to absorb the crisis that would have unfolded with the epicenter in the place that had absorbed the last one. The taxpayer would have faced a deflationary death spiral in 2019 and in 2020. It was forced on them, don't get me wrong, but that's what the taxpayer would have been facing, rivaling or even exceeding what the Great Depression looked like. And the reason why is because there was so much more rot and so much more debt built up in the system. But the government didn't want that to happen, and so they borrowed trillions of dollars into existence to bail out the taxpayer, which means the place, the epicenter of the next crisis is with the government themselves. In 1998, the crisis started with a hedge fund, was absorbed by the banks. In 2008, the crisis started with those banks and then was absorbed by the taxpayer. In 2020, the crisis started with the taxpayer, even though it was the government's fault, it started at the taxpayer level, and that was absorbed by the government. And now, the epicenter of the next crisis sits with the government themselves. The government is staring down the barrel of a sovereign debt crisis. What does that mean? It means that the government cannot tax enough to pay its liabilities, and so it must borrow the difference. But the rate at which it is borrowing is increasing its expenses faster than it can increase its income. In other words, it would be like you making $100,000 a year, spending $200,000 a year just on credit cards. You have to keep on doing a balance transfer just to get that introductory rate so your interest rate doesn't skyrocket and payments just get out of hand. But you can only make the minimum payment, but you also have to keep on funding your lifestyle that you keep on increasing. So not only are you just rolling over the existing debt, you're adding to it because you're still spending more than you earn. That's what the government's doing, except they're just taking your money because they don't make any of their own. And if nothing happens from here, the government defaults on the path we're on with no changes. That is the outcome. The government defaults. So the question is, how will they deal with this crisis? Who can bail out the government? Who can absorb that size of a financial ticking bomb? And the answer is the Federal Reserve. This is what always happens when any government throughout history faces a sovereign debt crisis. The central bank comes in and they print the difference. The central bank prints the money necessary to absorb the debt, to buy the debt, and take it onto their own balance sheet. That is done through things like quantitative easing and yield curve control, capital controls, and financial repression. These are financially tyrannical tools that governments for hundreds of years have used in order to try and get the central bank to successfully bail out the government when the government has taken on too many liabilities and obligations. And it is coming. Might not happen this year, might not happen next year, but we're already starting to see the signs of this popping up in the market, like gold doubling in the last year and a half. Gold does not make moves like this for no reason. It's because big money is front-running bad monetary policy decisions so that they can protect their purchasing power. And if you want to protect yourself from the consequences of this massive bailout that is coming for the government and all the money printing and the inflation that will happen as a result, you want to make sure you have very little exposure to government bonds. That also means cash positions. The real interest rate on those will be deeply negative over the coming years if history is any guide. You also want to have as much exposure as you can to real assets that have historically proven protection against inflation. Things like stocks, things like gold, things like Bitcoin, things like real estate, especially if you have a fixed rate mortgage on it. It used to be back in the day that you could just keep your head down, focus on your work, spend less than you earn, and that would be enough to be successful. But today, when they manipulate the money, when they steal your purchasing power, and when they financialize the economy through fiat, everybody must become a professional investor on the side. You need financial education. You need to become financially literate. You need to be constantly studying and watching. And if you're interested in just following along with what I'm doing, hearing my insights along the way, I've got a free newsletter. Sign up in the description below. And if you don't like newsletters, that's why I make these videos. As always, thanks so much for watching. Have a great day.